One hot summer day, under the scorching sun, the hero of the episode, Mr. Smith, was looking for an ice cream shop, but he couldn't find any ice cream shop in the neighborhood, and suddenly he had the smart idea to open an ice cream shop in the neighborhood. So he hurried home to plan his project. And he concluded that a project like this cost $10,000. But he only has $1,000, that is, only a little. The answer to many of your questions related to stocks in this episode and the next and the pro. So I advise you to subscribe to the channel. Mr. Smith sat thinking how he could get financing for his project. Suddenly an idea of financing his project came to him, without debt. So how is that possible? And what does this have to do with stocks? Follow us on this episode to find out. Hello friends, this is Rashad from your weekly program Hit the Road to Fire. Let's get back to the ice cream project. Since Mr. Smith has only $1,000, then he has $9,000 left to finance the project. He starts knocking on doors to convince the friends of the idea. But the answer of the comrades was a refusal, except 9 of them were enthusiastic. After the idea of the project was presented to them, each of them decided to contribute and invest $1,000 to launch the great project. And therefore, of course, each one of those who participated became the owner of 10%. In the business world, Mr. Smith's friends are called angel investors and venture capitalists, and it is this type of financier who supports emerging projects before even entering the stock market. And the project took off. Days, weeks, and months passed, and the ice cream shop began to grow, and people started visiting it from the neighboring neighborhoods. One day, Mr. Smith met with his founding friends and decided to develop the project, since they were successful. They agreed to expand it in all neighborhoods of the city. But like the first problem, their money is not enough to open new branches, and they want to avoid debt from the bank because its cost is higher and its legal issues are greater. They concluded that the best solution to financing the project is that you open investment in it to everyone who wants it. And is there anyone who does not like ice cream? What happens in practice is that the company says to everyone who is interested in the project, you give us cash in exchange for part of the ownership of the company. This is the idea of the initial public offering in the stock market. IPO, simply and in coordination with the banks and the government. Of course, the company presents itself in the stock market and says to everyone interested in the project, give us cash to become the owner of the project with us in proportion to the money you invested. This small portion of ownership is the stock. In the days of my grandfather, the stock was a real paper with your name written on it and how many shares you owned, as you can see with the old Coca-Cola stock that appears on the screen. So when you buy a share of the company, you are a partial owner of the company, and by buying all the shares of the company, you become the sole owner of the company. And if you are still not convinced that you are a real owner of the company, let me tell you that as the shareholder, you have some real powers, such as attending the annual investor meetings, voting on the company's board of directors, and even submitting suggestions for the direction of the company. Does that mean, if I bought a share in Apple, would I be considered the owner of the company? Exactly, dear viewer, but unfortunately they do not distribute a free iPhone to the owners. And to be precise, you will be the owner of one share of 16,334,371,000 Apple shares in the market. Let's go back to how Mr. Smith and his group personally benefited from putting their company on the stock market. When you buy company shares, you are actually giving them money to spend on establishing new branches, to advertising, and developing new flavors, in return for partial ownership of the company. By doing all of the above, the company's returns increase, and when the company realizes profits, you, as a partial owner, also make profits, and Mr. Smith also increases his income. Thus, everyone will come out as a winner. You, the company, and Mr. Smith all benefit from the company's offering on the stock market. And certainly you still remember the beginning of the episode when we mentioned that Mr. Smith and his 9 friends each contributed $1,000, meaning that each of them was the owner of 10% of the company. But this was before the company was put on the stock market. And when the company sold the new shares to new investors, the ownership of each of the founders decreased to less than 10%. Here the question remains, how is the process of buying and selling shares? It's as simple as you buy ice cream at the ice cream shop, you buy stock at the stock shop. But this stock shop is more organized than Mr. Smith's ice cream shop and has a business name, the stock market. And this is the stock market we hear about in the news. And every country or city sometimes has a separate stock market, like Nasdaq and New York Exchange in USA and many others. Therefore, when you want to sell the shares of a specific company, the process is done through the stock market and there is no need for direct communication with the company itself. Most of the companies, especially the large ones, offer their shares in many stock markets. I mean the Apple stock. Although it is an American company, you can buy it on the German stock exchange, for example. Even buying and selling transactions do not need to be carried out by yourself within the stock market. What I mean is that you will not go down from your house to go to a building called the stock market and trade there, as trade takes place as trading floors. Rather, you, as an investor, do your operations mostly through a bank or a broker, whether it is through a phone call or online. Let us leave the brokers now and focus on the useful. We are now partial owners of the company. Do we get a part of the company's profits at the end of the year? The answer, dear viewer, is yes and no. This means that the decision to distribute profits belongs to the board of directors of each company separately. And with our story, Mr. Smith and his group. Let's think about it. The company is in its infancy, seeking rapid expansion, so it needs all the money to spend on setting up branches, developing new products, in advertising and, of course, in employee salaries and other expenses. Therefore, there is nothing left of the profits to be distributed to investors. But after the company grows and reaches a kind of stability and the growth becomes linear and stable instead of basic and rapid, at this stage the companies increase their additional profits and here distribute the surplus part to the investors in what is known as dividends. Let's take the example of Apple, which launched itself in the stock market in 1980. But it did not start distributing profits until 1987. Meaning that it reinvested its profits for 7 years in order to accelerate the growth of the company. In principle, most of the emerging companies that present themselves in the stock market are losing companies, so how do you expect to get dividends? However, even some of the major companies do not distribute profits, and the closest example is Amazon, which has a market value $1.684 trillion because it is in fact still in the stage of rapid growth and needs the entire surplus of its profits to be reinvested. But pay attention, companies, and even that they start distributing profits, this does not mean that they will do so forever. It is possible that they stop the distribution of profits at any time. For example, because of the crisis that the world is currently going through, many car companies, such as those who took a break as Ford and General Motors, who have stopped distributing profits completely until further notice, to save, of course. And a second example is Apple, which started distributing its profits in the year 1987, as we mentioned before. It distributed profits until 1995. And after that, the management decided that the distribution of profits should be stopped and reinvested. And this is what actually happened to return to rapid growth for up to a year 2012, which is the year of redistribution of profits, since it has become sufficient surpluses. After learning about the distribution of profits, you, as an investor, can also profit from selling the stock itself. This means that you give up your ownership of the company and give the opportunity to others in return for the value of what you own. But why does the stock price go up or down in the first place? The answer to this question is related to the idea of supply and demand, which we will explain in detail in a future episode. But to clarify, when demand rises and supply decreases, the share price rises, and vice versa. When demand decreases and supply rises, the value of the stock decreases. We will simplify with the example of our ice cream shop. Let's suppose that Mr. Smith gets out of control and makes a decision such as selling only pepper-flavored ice cream, for example. What will happen about the demand and therefore the company's shares? And as an unfortunate investor in Mr. Smith's company, the drop in the stock price represents a drop in the market value of the company, and therefore a drop in the value of part of your property, and frankly speaking, a loss, and vice versa. I mean, if Mr. Smith manufactures a delicious flavor instead of pepper flavor, sales will certainly rise, and with it the stock price will be. So you as well will be a beneficiary investor. The second way to profit in the stock market to increase the distribution of profits is to buy shares with a low price and sell them after a while when the price rises. But when I buy the stock, and when should I sell it, and how many shares should I buy, and what are the types of investment? And what is the best company? And how do I choose companies? The answers to all these questions will be found in the upcoming episodes, so subscribe to the channel and activate the bell to receive notifications of all new. Let's go back to the topic. If you cannot buy shares during the IPO, as we mentioned, you can buy when a second investor sells, but there is a third way to buy a share. To simplify things, let us return to the example of Mr. Smith, who, one day, at a board of directors meeting, Mr. Smith and his group presented a great idea, which is to spread all over the world. But an expansion of this size, of course, requires huge sums, and if the company does not have sufficient funds, it has limited options to take debt from the bank, reduce the distribution of profits, or offer additional shares to the stock market after the public offering. And this is the third way to buy shares of the company you want. But offering additional shares on the stock exchange means an increase in the offer, so the share price will surely decrease, right? Wrong, dear viewer. In fact, it is not 100% wrong. Let me explain why. It is true that the company's offering of additional shares means an increase in supply, but do not forget that demand can also rise at the same time, and in the case of Mr. Smith and his plan to spread all over the world, what happened is that investors got excited because the company has a great potential for future growth. So what happened is an increase in the demand for the company, and therefore despite the high supply, the demand has increased exponentially. So what happens with the price? Yes, it rises, dear viewer. Subtracting additional shares in this case made you, as an investor, happy, and the company itself is happy because it was able to finance its expansion. And the idea of a company offering additional shares in the stock market is called secondary offering of shares. In fact, the example of Mr. Smith that we just explained is a somewhat special case, because in general investors do not like the secondary offering, and the reason is simply that when additional shares are sold, you as an investor, your ownership percentage of the company decreases, even though the number of shares you own has not changed. But I come back and mention that the secondary offering is useful for the company. We took a fictional example, which is the Mr. Smith ice cream company, but there is a real example. Tesla in 2020. Shortly before the crisis, additional shares were offered to the market, which made it obtain enough funds to overcome the crisis in peace. And as we know, during the crisis, Tesla performed much better as a stock than many auto companies, General Motors and Ford, and one of those reasons is the extra money they were able to raise because of the secondary offering. And we have a small detail left. As the company is selling its shares, it can buy its shares, but this is a completely second topic that we will explain in the following episodes. And as this was an example of the stock's rise, there are many examples of its decline. And all stocks are in this circle, rising and falling in the short term. But when we look at the bigger picture and in the long term, stocks are always growing despite the decline that occurs from time to time. People's demand for ice cream is always on the rise, so what do you expect? Certainly there is a permanent rise. It is true that Mr. Smith's ice cream company may fail for a number of reasons, we don't need to mention them now, but there are hundreds of companies whose stocks are going up, and you can invest in them all through index funds. This is a diversification strategy that we will explain in one of our upcoming episodes. And now you have a complete perception of everything in the stock, and it remains to talk about clear strategies and specific companies. In conclusion, the question remains, who is Mr. Smith? If you have a particular topic in your mind or a particular company that you want us to address, write me in the comments, I'd love to hear your opinion. Finally, I tell you our goal it is to spread financial awareness and culture. If you want to become part of Dream and Project, then support us with like and share episode with all your friends. See you soon.